Hi, and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will give an update to my portfolio where I go through the latest earnings release from some of the big companies, both within my portfolio and in the stock market in general. And afterwards, I will answer a question which I have received from the audience as well. So let's start with a quick update to the portfolio. Well, the first thing we immediately notice is that there was a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. If we go to the portfolio values tab, you can see that the portfolio has increased a little more than $2,000. But more interestingly for me is if we go to the dividends tab, and if I just zoom out a bit here just to give you a better overview, you can see that February has been quite a remarkable first week since I have received a little more than $250, and those came from LTC Properties, CVS Health Corp, Verizon Communications, and Bristol Myers. If we then go back to the overview arc here, then you can also see that the cost of the portfolio has not changed, meaning that I have not done any new investments. And if we scroll to the top here, just to give you a better overview of each individual holding in the portfolio, if we then start by focusing on Activision Blizzard, since I've been talking a lot about those in episode 99 and episode 100, then I'm happy to announce, if we go into Seeking Alpha, that Activision Blizzard has declared a dividend of 47 cents per share, meaning that the dividend is in line with previous, and they have an ex-dividend of 14th of April, meaning that you need to buy the stock and have it in your portfolio on the 14th of April to be eligible for the dividend, which will be paid out on the 6th of May. And this is the equivalent of a 0.6% forward yield. So why am I all of a sudden happy to see that Activision Blizzard has declared a dividend of 0.6%? Well, basically, this was due to the fact that one of my viewers questioned whether or not Activision Blizzard actually fits into my strategy of building a passive stream of income. And I mean, since this company is paying a dividend, they fit the criteria. I know they are below my guidelines of a starting yield of above 3%. But as I have mentioned, I am not buying Activision Blizzard based purely on the dividend. This is based on the fact that I believe that Microsoft will indeed pay $95 per share sometime during 2023, which will give me the annualized rate of return between 9 and 18%, depending on when in the year it happens. But at the same time, since the company is paying a dividend, I will argue that they actually fit into the strategy as well. So let's continue to Unum Group, which is the second largest position in my portfolio, and specifically the earnings call. But before we go to the earnings call, let me show you why I think it is actually important that you follow these financial releases from your investments. Because if you are like me, using a page like Macro Trends, then you can see that currently you don't really have the latest update on Unum Group, for instance, when it comes to their book value per share, even though this earnings release was out on the 2nd of February, meaning 4 days prior to this recording. But if you go to Unum Group, you go to the earnings release, then if you look into the report, then you can see that the book value per share is reported as $56.37, and in fact, when you looked in here, you can see that that number is very clearly missing. So this is just an example of, even though Macro Trends is a wonderful, free, available tool to use, then from time to time, you will have to look at the dates and be aware that maybe you are not seeing the latest news and you will have to check somewhere else to get it. And as you can see, it's still free available on the company specific webpage if you want to go and read there. So if we start with the first bullet point here, then we can see that the after-tax operating adjusted income was $182 million, or the equivalent of 89 cents per diluted common shares. Let's see how this stacks up against the consensus estimate from the analysts. And to check how this stacks up against the consensus estimate, well, we simply go to Yahoo Finance, we type in the ticker code UNM, we go to financials, and then we scroll to the side here. On the earnings, you can see that the consensus estimate was 84 cents per share, meaning that you see this green dot that they are in fact beating the consensus estimate. This would indicate that we would expect the stock to actually increase, since everything that we're talking about in the stock market is about future expectations. So when a company delivers better than expected results, then you would expect that the stock will increase in value. Of course, there are numerous occasions where this is not the case. For instance, if the market as a whole is severely dropping. But if you had to make a rule of thumb, then every time that you see a green circle in the earnings beat from companies, well, then you would expect the company's shares to increase in value. So if we switch from financial to chart, then it is not too surprising to see that when the earnings release was announced on the 2nd of February, that the stock price increased. But please note that this does not serve as a proof that this will always be the case. There's a reason why I just called it a rule of thumb, because in the short run, there is so many things that goes into determining the price of a stock. So that is the reason why I just call it a rule of thumb, simply due to the fact that it is a anything else being equal assumption. And you cannot make that assumption because anything is not else being equal. So just from the first bullet point of the earnings release, we know what we would expect from the market in the short run if we could make this assumption of anything else being equal. Unfortunately, this is not the case, so we have to read more and see how the business is actually doing if we actually want to call ourselves investors and not speculators. So if we go back to the earnings release, it is not too surprising, since we are talking about an insurance company, that they need to have a bullet point reserved for this global pandemic and how it has affected their result. If we then go to bullet point number 3, I'm happy to see that they have a strong liquidity position of 1.5 billion in cash. So they will be able to cover the insurance or claims. And what I'm really happy to see as an investor is bullet point number 4, that in addition to a stable dividend, they have done capital deployment of share repurchases of $50 million. I'm happy to see when a company I have invested in are repurchasing shares, particularly when I believe that the shares are undervalued. So I would say that they are using their cash wisely. So why do I believe that this company is actually currently undervalued by the market? Well, if we look to the book value where we started, $56.37 per share. If we then go back to macro trends here, look at the historic book value for this company. Over the last 14 years, how many times have you actually seen the company trading of half its book value or lower? You can see here in 2020 there were really good opportunities, but otherwise over the last 10 years, it is actually not that often that you see this company trading of only half its book value or lower. So if we look to the graph here in the middle, we can clearly see that there are ups and there are downs. But if we had to draw an overall trend line, then we would say that this is trending upwards. So what I'm willing to do is, or you can essentially say, which I have already done, is I have invested my money into a company where I believe that they can continue to grow the value, and I believe that they will continue to do so until this will be appreciated by the market, meaning that the stocks will be trading at a higher price at which I have bought them for. So essentially what I want to get out of a quarterly report like this is that I want to see the net income is growing. I want to make sure that there is a strong balance sheet so this company can weather whatever storm is potentially coming up. Hopefully I want to see that they're doing something good for their shareholders, meaning either increasing their dividend or buying back shares, especially if I believe that the shares are undervalued. And at the same time, I want to see that they are growing the book value, meaning that they are growing their assets more than their liabilities. So as a quick checkup to my investment, well, these are just the headlines Of course, if I want to dive more into the details, for instance, if I'm seeing something here which I do not really like and I want to know more, then you can always continue to read on this 10-page document and look at segment by segment if there are some numbers that you want to know more about. And on top of that, if we go back to the webpage, you can also see that there's this statistical supplement and notes. And if we open that, then we see that we now have a 42-page long document. So if you want to know more about the business, then there really is a possibility to do so. And this would be the right place to learn more about the business if that is what you are after. So if you believe what you have just watched, or if you are reading stuff like this and you find it as fun as watching paint dry or something similar to that, well, chances are that you should probably just be buying an index fund, simply due to the nature that if you know nothing about what you are investing in, chances of you beating the market is very slim, and then just accept that fact and buy the market instead. There's absolutely nothing wrong about that approach. So if we go back to the portfolio overview here, you can see that Unum Group is my second largest position, and essentially there are three questions that I need to ask myself here. Do I consider selling? Would I like to continue to hold? Or would I actually consider to buy more? And after seeing this earnings report, well, I'm not considering selling, since I don't believe that the stock is overvalued, and I haven't seen the fundamentals of the business completely eroding. Hence, selling would not be an option for me. Holding? Well, continue to hold seems like a pretty viable option. And then number 3, would I consider to add more? This is more an individual preference on if it actually fits into your portfolio, and also if you believe that you can do a better deal somewhere else. So then you have to look into your portfolio mixture and see, do I actually need more in the financial services, or do I want to, even within the financial service, diversify there and have multiple companies, or am I actually comfortable with having just 10% in one single holding there? If we then continue with two of the tech giants, if we start with Alphabet, I mean, if you look to this 5-day price chart, when do you believe that their earnings call was released? Well, if your guess was on Wednesday and you guessed that they beat the estimate, well, if you scroll to the side here, then you can clearly see that you would have guessed correctly, since they have beaten the estimate over the last 4 quarters. And if we then continue to Facebook, or Meta platforms as it is called these days, then you very clearly see what happens to the share price if you miss. I mean, look at this. This is the first time Facebook have missed, and they only missed by 17 cents per share. But nonetheless, if really high expectations are priced into the share price, then you see the stock plummeting once this happens. This is where I believe Benjamin Graham is so correct when he says, whenever the stock price increases, the stock becomes more risky, not less. If we then continue to questions from the audience, then I have received a question about how I calculate my buy value if I have done multiple purchases in the same company. So if we take an example and look at ATVI here, the way I reach the buy value is by taking the invested amount and divide by the numbers of shares that I have. So if we say that I, for instance, have bought 100 shares and then bought an additional 30 shares, then I will calculate the amount invested for the 100 and for the 30. I will add those two numbers into the invested column, and then I will take the invested amount and divide by 130, and that is how I reach my buy value. So now you know how I have calculated the buy value. If you then at a later point decide to sell some of the shares but not all of them, then I highly suggest that you go and watch episode 89 about the FIFO principle, meaning first in, first out, in order to figure out how much you have gained or lost on your shares. So that actually sums it up for yet another exciting week of the Lazy Money Game. So if you have enjoyed the content, then please consider leaving a like. It really helps out the channel a lot. And until I see you next time, bye!